There's a hidden rule in Monopoly game that Hasbro never prints on the box. Surprisingly, it is the same rule that the Federal Reserve have to follow in order to keep the economy move forward, and most importantly, how it create wealth inequality. The rule says that the bank cannot go bankrupt. If the central bank somehow runs out of money, the Fed is instructed to print more, and therefore the game continues. But why has this particular rule become so important? That's because in 1730, a French-Irish economist named Richard Cantillon wrote down exactly why you'd never be able to afford a house in 2024. Surprisingly, his manuscript sat unpublished for 25 years after his death because apparently nobody cares. But when it finally appeared in 1755, the people who read his manuscript see the same vision and got extremely wealthy at that time. You might never heard of his name, but his work has left a massive influence on a modern world economy more than you think. Cantillon was born in Ireland, probably around 1680s. He built his career in Paris during one of the most financially chaotic periods Europe had ever seen. And because he was a banker, he's operating inside the system, moving people's money, managing risk, and watching how wealth actually flowed between the peoples in real time. So, therefore, he clearly knows what he was doing. But the moment that defines him come in 1720. John Law was a Scottish financier with the backing of the French crown. He had created the Mississippi Company, essentially a state-backed corporation with a monopoly on French trade in Americas. Because of that, he needed to fund it. Therefore, Law printed paper money on a scale that France had never attempted. Had become one of the first mass fiat currency experiments in modern European history. And for a while, it worked. Share prices exploded, and people who got in early got rich almost overnight. Richard Cantillon is one of them. But he was doing it differently than most of the investors. He borrowed heavily and bought Mississippi Company shares while they were still rising, but then he did something most people around him couldn't bring themselves to do. He shorted them on the way down. That's because he saw the bubble for what it was, so he positioned himself accordingly and walked away with approximately 10 million livres while the broader French economy fell apart. The most interesting part that I found is he didn't do anything through a fraud. He did it through a simple proximity. Therefore, he was closer to the mechanism than they ever were. But it just got better. Between 1730 and 1734, he wrote down exactly what he had learned. The manuscript is called Essai sur la nature du commerce en général, but it just sat there unpublished until 1755, 25 years after his death. Adam Smith read his manuscript before he's writing Wealth of Nations. Cantillon's ideas became the foundation of classical economics. It wasn't called the Cantillon effect until 20th century. Economists rediscovered it and gave it a name. Economist Murray Rothbard later called Cantillon the true father of modern economics, the intellectual grandfather of the Austrian school. But here's the thing. What makes him different from the most economic figure you've probably come across? He wasn't issuing a warning, nor he was trying to fix anything. He describing with the calm precision of someone who had personally operated the machine exactly how new money moves through an economy and why the people closest to its source always come out ahead. That's just the confession dressed up as scholarship, and we're about to break it down bit by bit. Here's the line from the essay that stops most people cold. Cantillon writes, "A river which runs and winds about in its bed will not flow with double the speed when the amount of its water is doubled." That's the whole thing. That's the Cantillon effect in one sentence, written in 1755 and translated by Henry Higgs. What it means is that new money doesn't land everywhere at once. It enters through a specific door, moves through specific hands, and hits prices along the way. By the time it reaches the last person in the chain, the prices that person faces have already adjusted upward. The same money with totally different purchasing power, depending entirely on where you were standing when it arrived. So let's put this on the Monopoly board, because that's actually the clearest way to see it. Picture the Go square in the corner as the Federal Reserve. When the Fed creates new money through quantitative easing, it doesn't drop equal amounts into every player's lap. Therefore, it flows outward from that corner through a very specific set of pipes. The first people it reaches are the primary dealers. There are roughly 18 of them, major financial institutions with a direct trading relationship with the Fed. When the Fed buys assets, it buys from them first. These dealers receive money before any price in the broader market has moved to reflect the new supply. So they deploy that money into stocks, real estate, and other assets at yesterday's prices. That's not luck, that's positioning. Next in line are commercial banks and large corporations. By the time money reaches them, prices have nudged up slightly, but they're still ahead of most people. That's because they can borrow it cheaply, buy assets, and expand balance sheets while the rates are low and valuations haven't fully repriced yet. The last people the money reaches are wage earners. They get it through paychecks eventually, after everything it could have bought has already moved. They show up to a board where the boardwalk already has a hotel. Not because anyone locked them out deliberately, but because the structure of how money travels guaranteed they'd arrive last. Cantillon mapped this same chain in Part 2, Chapter 6 of the essay using the example of a gold mine. Now, think about this for a second. The mine owner gets the new money first and spends it before prices rise. And therefore, the merchants who supply the mine owner see increased demand and raise the prices accordingly. But it just got worse because the laborers in distant regions receive higher prices without the proportional wage increase right away. So the mine owner in 1730 is equals to primary dealer in 2008. The regional merchant equals the commercial banks, and distant laborer equals wage earner. The chain is identical, only the names has changed. And this is the part that people miss when they first hear about this. There's no villain in the story, no room where powerful people sit around deciding who wins and who loses. The outcome is structural. It's the mechanical result of money entering an economy through financial intermediaries rather than landing directly and equally in people's accounts. When that's how the system is built, proximity to the source isn't a reward, it's just physics. Cantillon understood this because he lived it from the inside. The Mississippi Company wasn't just a historical footnote to him, it was his lab. And what he wrote down afterward wasn't a warning to future generations, it was a field report. Now that we've seen the structure behind the chain, let's take a look at what actually happened when the Federal Reserve ran the largest monetary expansion in the history of modern central banking. And trust me, it's not what you expected. The database is called the Distributional Financial Accounts, or the DFA. The Fed releases it quarterly in order to track wealth ratio held by American households, broken down by net worth percentile, going all the way back 1989. So basically, it's the Federal Reserve measuring its own impact on the wealth distribution of the United States, using those numbers in a valid methodology. We're gonna deep dive into the rabbit hole and see what those numbers show. In late 2008, when quantitative easing began, the Fed's balance sheet was roughly $900 billion, and by the early 2022, it was nearly $9 trillion. The balance sheet grew 10 times bigger across the 14 years' time, with the biggest expansions happening in 2009 and then again during the COVID response of 2020 and 2021. Now watch what happened to wealth shares across that same window. The Federal Reserve's official tracking for the top 1% wealth share sat at 25.9% in early 2009, and by the end of 2020, at the peak of the COVID-era expansion, it had climbed to 31.1%. That's more than 5 percentage points added to the share of 1% of the population during the single biggest money creation period in American history. 5 points sounds small until you realize that it's the total wealth of US households runs into the tens of trillions of dollars. 5 points on that base is a number that takes your breath away. Compare that to the Federal Reserve's official tracking for the bottom 50% wealth share. In early 2009, roughly 130 million people held approximately 1% of national household wealth, and by the end of 2021, they only held about 2.8%. Well, that's technically an improvement, but if you think about it, 130 million people still held under 3% of national wealth at the end of the largest monetary expansion in history. The gap just didn't close, it widened at the top while staying essentially flat at the bottom. The Gini coefficient, the standard measure of wealth inequality, also rose during these 14-year experiment. The asset numbers explain exactly why. Across the money printing era, the S&P 500 rose approximately 600%. The Case-Shiller U.S. National Home Price Index rose approximately 180%. But the inflation-adjusted median household income across that same period of time only rose approximately 8%. That's just the gap between people who held assets and people who held jobs. The reason that gap was basically locked in before the first dollar of new money was deployed comes down to one number. The top 10% of American households hold approximately 84% of all corporate equities. That figure comes from the Fed's own DFA data. So when the asset prices rise, I mean any asset prices, 84 cents of every dollar of new wealth goes to 10% of households. Not because of anything those households did in response to the money printing, but because of what they already owned when it started. Economist Robert Reich, in Inequality for All, noted that 95% of the economic gains following the 2009 recovery went to the top 1% by net worth. The structure made that outcome close to inevitable. Now hold all of that next to what Cantillon wrote. His mine owner spends new money before prices move, so his regional merchant receives it next at slightly higher prices, and therefore his distant laborer arrives last, into a market that is already adjusted. Replace the mine owner with primary dealer and replace the distant laborer with median wage earner, so you can see watching the home prices climb 180% while their income moved 8%. The chain Cantillon mapped in 1730 using French land rents and silver coins ran itself again across 14 years of new money flowing through the same old pipes, and the Federal Reserve's own regular reporting captured every step. He described it as a river. The water doesn't double in speed just because you've doubled the volume. It finds the path of least resistance, moves through the channels that already exist, and by the time it reaches the far end of the basin, the people there are dealing with a landscape of the headwaters that already changed. This is really concerning, and because of that, somebody really did try to tell us multiple times across more than a century by the people who understood exactly what Cantillon had mapped and wanted everyone else to see it too. What happened to those warnings has its own story. Start with Henry George. In 1879, a San Francisco journalist and self-taught economist published a book called Progress and Poverty. His central observation was this: the railroad boom was creating enormous wealth, but that wealth wasn't accumulating with the workers who built the railroads or even the entrepreneurs who ran them. It was pooling with landowners, the people whose property sat closest to the new lines. They hadn't built anything. They had simply been near the activity when it arrived, and proximity made them rich while everyone else paid higher rents to access the economy the railroad created. George didn't have Cantillon's name for it, but he had seen the same mechanism operating on American soil, and he spent 500 pages explaining why it was structural rather than accidental. His proposed fix was a single annual tax on land values, replacing all other taxes. The idea was that you should keep everything you produce, but the unearned gains from simply owning land near economic activity should return to everyone. His followers called themselves Georgists. At the peak of his influence, Henry George came close to winning the 1886 New York City mayoral race, finishing ahead of a young Theodore Roosevelt. That intellectual chain runs directly back to Cantillon. Part 1, Chapter 12 of the essay maps how landowners capture gains from new economic activity long before wages adjust. George's 1879 thesis is, in many ways, that chapter scaled to an industrial economy. The names and industries just changed, but the structure Cantillon identified didn't. One of the people who read George and took him seriously was a woman named Elizabeth McGee. Born in 1866, she was a feminist and a committed Georgist whose father had been a close friend of Abraham Lincoln and a devoted follower of Henry George's ideas. She filed for a patent in 1903 for something she called the Landlord's game, which became the original idea for the monopoly board we know. Her stated purpose in the patent application was direct, a practical demonstration of the present system of land grabbing with all its usual outcomes and consequences. She was building a teaching tool, and she built it with 2 complete rule sets, which is the part of this story that almost never gets told. The monopolist rules worked the way you already know. One player accumulates everything, everyone else goes bankrupt. Game over. That was McGee's portrait of the Cantillon chain running unchecked, proximity compounding into monopoly, the board clearing itself. The prosperity rules worked differently. Under them, whenever any player acquired wealth, all players benefited. The game was designed so both endings were playable, so people could feel the difference between a system that concentrates and one that distributes. The contrast was the lesson. Parker Brothers bought her patent in November 1935 for $500 without royalty, so Charles Darrow, a salesman, presented the game to Parker Brothers as his own invention, receiving full credit and royalties. They kept the monopolist rules and removed the prosperity rules before mass production. The Georgist solution, the point of the whole thing, was stripped out before the game reached a single shelf. Now, the other side of the story is kinda ironic, that because money printing was the price of admission to keep society running, it prevented a total credit meltdown that would have wiped out a generation of savings. It wasn't done for fun, it was a desperate move to stop a freefall, and it worked. But the Fed's own numbers don't let you stop there. When 84% of equities sit with 10% of households, rising asset prices don't spread evenly, they concentrate. The pension gains for the bottom half were real, but tiny relative to the base. Cantillon never called the mechanism evil, he called it structural. Those are different arguments entirely. The people who built wealth moved closer to the printer. Assets over cash, equity over salary. Please watch my other videos similar to this one if you enjoy useful insight and lesson like this. I hope you learned something useful from this, and please consider subscribe for more valuable content like this, and hit that like button to make the algorithm works on your favor. I'll see you next time.